Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things you need to know today.
First up, U.S. stock futures falling this morning as trade volatility returns to markets. President Trump lashing out against China today, saying they have violated their trade agreement. His comments coming after Treasury Secretary Scott Bessent said talks with China are, quote, a bit stalled. All of this following a federal appeals court ruling that offered a temporary reprieve to Trump from the trade court that had deemed his tariffs illegal.
Plus, the latest read on the economy out this morning. Inflation data coming in soft for the month of April, but consumer spending is showing signs of slowing. The standout in today's economic data, however, are some of the imports to the U.S., which saw their biggest drop on record. April imports fell nearly 20% last month, according to the Census Bureau's Advanced Economic Indicators report.
And Gap shares sinking this morning after the company predicted a tariff impact of $250 to $300 million and revealed weakness at Banana Republic and Athleta. The retailer is just the latest in the sector to highlight the impact of President Trump's trade war, the stock falling as much as 18%, putting it on track to erase almost its entire year-to-date gain.
Investors digesting fresh economic data out this morning. The Fed's preferred inflation gauge, PCE, coming in lower than expected on an annual basis. Here with more, we've got Fed correspondent for Yahoo Finance, Jennifer Schonberger. Jennifer, what do we know here?
Yeah, Brad, honestly, these numbers look really good on their face. Inflation clearly cooling in the month of April, even as tariffs kicked in full blast. And this is likely to keep the Fed on hold, though, because the Fed is in a strange juxtaposition here, right? The hard data looks really good. Inflation continuing to cool this year. At the same time, they're focused on the outlook, specifically the impact of tariffs as it relates to inflation. There is an internal debate now within the Fed whether higher inflation from tariffs, if we see it, we haven't seen it yet, at least in this report, could prove longer lasting, or if it will be a one-time increase in prices. The Fed is keenly aware of the mistake they made coming out of the pandemic, when we had that supply side shock, when they looked through inflation thinking it would be transitory, only for inflation to prove the worst we've seen since the early 1980s. So that is why the Fed is going to stay on hold despite this really good data. I mean, and you look at this headline at 2.1%, they're practically at target. Core falling to 2.5%, which is their preferred gauge, and it excludes those volatile food and energy prices. And if it weren't for tariffs, the Fed probably would be cutting. In light of this inflation data, President Donald Trump likely to call on the Fed to lower rates. Again, I don't expect them to do that. And I just want to flag Dallas Fed President Lori Logan's comments last night. She sent a strong, veiled message about holding rates steady in the face of the president's calls for lower rates. She said that, quote, rates are in a good place now, and it could take, quote, quite some time to know whether the balance of risks is shifting in one direction or another. She went on to say that the effect of rate changes will take time to play out. And to get the balance right, we always have to think about where the economy is headed, not where it is just right now. She said in the short run, a central bank could always, quote, juice employment by cutting interest rates. People might enjoy that for a little while, but over time, excessive rate cuts would trigger a spiral in inflation. So that kind of gives you a sense of where the Fed is now. Again, Brad, great numbers, but it's probably going to keep the Fed on hold.
And Jennifer, just want to follow with you on President Trump's meeting with Fed Chair Jay Powell this week. Talk to us about what came out of that meeting.
Yeah, it's funny because 3 weeks ago, Maddie, I asked Fed Chair Powell, why haven't you requested a meeting with President Trump in light of all this uncertainty? And he said, I would never request a meeting with the president. The president would have to call on me. Of course, the Fed is an independent agency, and that is the typical protocol. Trump was asked the following day whether he would meet with Powell or call for a meeting. He said it's like talking to a wall. 3 weeks fast forward, and looks like Powell met with Trump. Trump apparently tried to push Powell to lower rates in the meeting, some of the same thing that we've seen play out in the public eye. Powell, according to statements from the Federal Reserve, did not talk about monetary policy with the president, but said the purpose of the meeting was to talk about the outlook for the economy, inflation, and employment.
Jennifer, always appreciate your reporting. Thank you so much. Tariff volatility is back on Wall Street. President Trump lashing out against China this morning, saying China has violated its agreement with the U.S. Meantime, Treasury Secretary Scott Bessent saying talks with China are, quote, a bit stalled. His comments coming after a federal appeals court offered Trump a temporary reprieve from that ruling that did deem his tariffs illegal. Joining us now to break down where to ride out the trade-induced volatility is Cole Smead. He is CEO of Smead Capital Management, which oversees more than $7 billion in assets under management. Cole, it's great to have you in the studio.
Good to be here.
Thank you for being here. We were just talking about this morning's inflation data indicating that there is a little bit more progress when it comes to prices than we saw in the consumer price index print, but the tariffs still remain a headwind, and that certainly played out in this morning's economic data. How does that impact your investments going forward?
Yeah, you add one more thing. You had consumer confidence hit a low that we saw in 2020, a low that we saw in 2009, and also 2011, okay? And I say that because when you put all these things together, I think it's really incredible how the U.S. economy has functioned despite high levels of uncertainty, particularly for business spending, okay? If you go talk to business owners right now, they're pretty scared about the whole tariff situation. I was at an event, someone was, makes guitars for a living, and they were just, freaking out. Go talk to people on Main Street, and they're not like at soccer practice being like, what's going on today with tariffs? And I say that because it shows you the difference between business.
Are they not, though? Consumer sentiment numbers have been plummeting.
In New York, yes. But in Main Street America, no. That's the big difference.
What is your evidence of that? Are you talking to people across America?
Well, I just mean if you just go talk to people day to day. Like I run into investors, I run into people in the media business, and I run into people in business owners. And again, that's a big idea for them, especially if you import or export your goods. Okay. When it comes to day to day beyond that, that's just not showing up. And I'll give you a picture of this. What are we spending in deficit? It's 7%. We normally only spend that, if you look back at the history, we did it, big deficit in World War I, big deficit in World War II, but we quickly tightened up our budget to get back to a much lower level of deficit or none at all. We have not tightened our belt at all. And what that's doing is it's providing this huge economic stabilizer and buffer in the economy. So this is a lot of uncertainty to pour onto the economy in, say, a 60-day stretch. And yet at the same time, the economy's not falling off, consumer spending is not falling off. Why not? And the answer is because it's really tough to stop an economy when you're spending this much in deficit. And no one's really saying that, by the way.
Well, to the very report that you just mentioned in the consumer confidence, they actually wrote in and said that tariffs are still top of mind for consumers' minds. That was in the write-in responses, the first mention in that stanza as well.
Correct.
So to say that they're not talking about it is incorrect based on that same report.
But you look at the spending, though, isn't going negative.
What you're saying is the difference between the soft and the hard data, it sounds
Correct.
like.
When also that soft data is bad data to invest based on. So at low points in the data, what should you expect? That the economy is going to pick up. Because I said 9, 11, 20, and today. And so I would expect the economy picks up because when those people survey, they're telling you, like the weatherman, hey, it's sunny today. And it's like, well, I already know that. They're telling you that there's uncertainty. But the reality is you can't invest based on that. I think we're going to wake up in 6 to 12 months. What we're going to find out is we did not slow the U.S. economy because until we slow our deficit spending, you can't slow it.
What is the investment thesis when you have what now is more commonly known as the kind of the tariff taco trade as well here, where the acronym Trump always chickens out, which he is asked about. And Wall Street is also trying to wrap their minds around because even in a note from UBS, they acknowledge that this changes every single day here, and we're seeing a lot more of these notes from major institutions saying at the time of writing, this is happening, but this could all change in a moment's notice on a Truth Social post.
The thing that doesn't make any sense to me is right now we're talking, go back to the fiscal deficit. We're watching the 10-year and the 30-year move higher. Okay, and all the big banks will talk about, gosh, this is really, this is worrying. We could have a big move in the cost of capital for our government. And then you pivot over the equity market, and the equity market's like, who cares, bro? Okay, in other words, why are we so worried about certain problems in certain parts of the asset markets, and then you pivot to elsewhere? So that's a part that doesn't make any sense to me. Why are we worried about treasury costs and kind of the effects that tariffs will have on the economy and thus those treasury costs? Well, at the same time, if you look at stock valuations, not a care. There's not a problem in sight when you look at the valuations of the S&P 500. Particularly, here's the interesting part, there is no history that industries that use major capex ever succeed in the stock market either. And it just so happens that the biggest US companies, the hyperscalers as they call them, is doing more capex than any point in US history.
Right.
And it didn't work for the railroads. It took about 70 years. It didn't work for the oil companies in the 2010s either doing that. And supposedly we've solved that issue because it's American exceptionalism that we know that isn't as exceptional as we once thought it was.
And it's certainly in question. Talk to me about how that informs what you've been doing with capital. What have you been doing over the course of the month of April?
Yeah.
I noticed this morning we're up 4% since April 2nd. So it seems like investors have moved on, but what sectors are you putting more capital?
Yeah, so back to the strength of the economy. I think people have, anything economically sensitive, people have really given up on, okay? Let me give you an example. We own Mall REIT, so we own Macerich, for example. Right. That's a business that earlier this year was trading at over $20 a share. You wake up and it's at 14, down 40% in a very short period. What's happened as their data's come out and the leasing spreads are showing up, what are we finding out? That since no one's built malls for years, and we're not gonna build any malls for years to come, Class A or high-end malls have nice leasing spreads. Why? If you're a high-end retailer, premium, luxury, whatever that may be, where else are you gonna go to attract customers outside of digital clicks online? And so what we're seeing is that some economically sensitive businesses that have good economics are just being left out there. Ulta reported yesterday, for example, we own Ulta. That's an addictive legal drug. I have teenage daughters. I've learned that it's a generational legal drug. And so I just point that out because that's the spaces in some of the retailing space. I mean, use the news this morning on OPEC Plus, okay? Oil is right in the crosshairs of the economic sensitive conversation. Two parts. One, what is OPEC doing? And then secondly, what are tariffs doing to the economy and what's the economy gonna do? Economic sensitivity is really cheap in the stock market. It just is that's not really dominating the market cap of the S&P today.
Just quickly while we have you here, I think, John, the stat was best May since 1990 we might be looking at closing out here, depending upon where the market closes here on the day. With that in mind, what do you do in June if you're an investor trying to figure out, okay, if my checklist has already seen this massive rebound in May off of some of the pullback that we'd seen during April and the rebound there that ensued as well, what holds for the post, what would typically be the sell in May and go away type of period?
Here's your cold water, okay? When the tech bubble peaked in March of 2000, we almost got back to that high 5 months later. It didn't stop it from being a nasty bear market, though. I think that's the reality of the situation. I think this is kind of a degenerate market where the dumber you are, the more foolish you are, the more money you've been making. And that's got to end because ultimately the stock market was not formed to get everyone rich. It was created to move money from those that are impatient to those that are patient. And I think we saw in April that not everyone was as patient as we thought they were.
Cool. Good to see you here this morning. Thanks so much for taking the time in studio.
Thank you.
President Trump taking to Truth Social this morning, claiming China violated its trade agreement with the U.S. It comes a day after Treasury Secretary Scott Bessent says the stalled trade talks could warrant a call between President Trump and President Xi. Despite the 90-day pause on reciprocal tariffs that went into effect May 14th, tensions remain high. Here with more on the ongoing negotiations, we've got Jeannette Lowe, who is the Strategas Securities Managing Director of Policy Research here. I just want to get your reaction to the latest via social media this morning from Trump and what that could entail kind of going into the weekend.
Well, thank you for having me. I think one of the things that's interesting is that, we had a court decision on Wednesday night overturning the authority for the president to impose tariffs using national emergencies. Then you did actually get the stay yesterday, and now here you have Trump pressuring China over its deal that they reached to lower tariffs from the really high rates of 125% down to 10% or 30%, depending on which tariffs you're calculating at the time. But I think the point is that Trump is also trying to pressure trade partners to show that he is still going to pursue this trade agenda of his, even if there is some uncertainty that has been caused by the court decision earlier this week. And we've always been of the view that trade decisions are going to be a little bit different with China than the rest of the world. We think Trump is going to be much more hawkish with regard to China than he is with other countries. And this kind of plays into that, where he is really trying to pressure China and show a little bit more stringency with them with regards to the tariffs and talking about the fact that they are not moving well in a particular direction to get a deal. But that was not necessarily a surprise. I think if we had seen a message like that coming from another country like Europe, which we saw last Friday, that would have been probably a different story.
Yeah, I think that's a really great overview, and it's something that is interesting given the fact that we did have this appeal coming in overnight here. I'm just curious, Jeannette, can you kind of lay the groundwork for where you see these tariffs heading at the current moment? Like, did this ruling actually put any sort of bounds on the president's tariff policy, in your view, that are going to stay in place long term?
Right. I think the main point is that it put a barrier on the president's ability to do it in an unbounded manner. That was kind of the word that was used by the Court of International Trade when they made their decision. So I think what's important here is that it makes it more difficult for Trump to impose more tariffs, but it doesn't take away his ability to do so. So the administration has a backup plan. Obviously, if the tariffs had to be removed immediately and the stay had not been granted, that would have caused a lot more disruption to the markets to put tariffs on, take them off, then they're probably going to go back on again. But I think what's important is we showed that we still have Section 232, which is the way that the Trump administration is imposing tariffs on goods like steel, aluminum, autos, auto parts, potentially pharmaceuticals and semiconductors in the future. And then there's also these other authorities. So we had Section 301 that was used to impose tariffs on China in Trump's first term. That is still a tool that can be used to even increase tariffs on China quite quickly. But then the Trump administration has other tools. There's a talk about whether or not he could put some tariffs in place at 15% for 150 days while they do investigations on a country by country basis to then impose other tariffs. That's kind of a clunky way to do this. But at the same time, there's another method as well. There's Section 338, which means that they could put tariffs in place. They'd only have to wait 30 days. They don't have to do an investigation, but they could impose tariffs up to 50%. So I think the larger message is that the tariffs are not necessarily going away. There's just probably even more uncertainty now about what comes next and when will this play out through the legal system. And do we keep the current tariffs in place, or does the administration need to go to a backup plan?
What's the probability that that takes place before the deadlines, which are quickly approaching in about now, I guess after next week, 30 days that we're going to be looking at left before some of these truces start to have run their course at that point?
Exactly. I think it's probably, we think this is going to go all the way to the Supreme Court. It seems unlikely that we would have a decision before July 9th. The Court of Appeals is obviously asking for statements from both sides on the motion for a stay. They're expecting to maybe rule on that in mid-June. Now, it's possible, obviously, you could get the Supreme Court to rule before July 9th, but it may not be the case. So that's something we'll definitely have to be on the lookout for. One thing I think it'd be interesting to watch is, we've only had one deal really so far with the United Kingdom. So the administration is trying to get a lot more of these deals done before July 9th. It's proving to be a lot more difficult than I think maybe they even anticipated. So one thing that would be interesting to watch is what happens at the G7 in mid-June. There was the possibility that maybe we could have a deal with Japan at that point. If none of those deals come through, then at that time, that could show that this is going to really butt up closer to the July 9th deadline. But maybe if we actually get a deal or two announced at that point, it'll show that countries are just willing to make deals now because they know the overall tariff regime is not going to change, whether it's the current version or a new version.
And final minute here, if the tariff revenue is impacted by all of this back and forth, how does that impact the taxes that are potentially going to be coming in, the tax cuts?
Yeah, I think this is a really good point because the tariff revenue has actually been coming into the U.S. Treasury at quite an accelerated rate over the past couple of weeks. And so what we've seen is that it's about $190 billion on an annualized basis coming into Treasury. So over 10 years, if this were to remain in place, that's $2 trillion of tax revenue or tariff revenue that's coming into the U.S. Now, obviously, if the tariffs get pulled back and there's a lag time, that would change that trajectory. But this is also not even the full breadth of what the Trump administration was looking to do in terms of tariffs. So tariff revenue does provide a backstop for any deficit increase that may come from the tax and spending bill. If those tariffs were to be pulled off, that would obviously reduce make the deficit less better from its current trajectory. And it could play into a little bit into Congress's mindset as they continue to finish this bill before July 4th, potentially. But now that the tariffs remain in place, I don't think it's really going to have as much of an effect, because even though Congress wasn't really thinking about including the tariffs as part of the overall package and then what their revenue would be, it does also keep them in place, which means that right now Congress doesn't have to worry about that revenue stream coming away. But it might be something that they continue to keep about going forward, particularly the fiscal conservatives in the House and Senate who would be worried about what that's going to happen to the deficit long term.
Jeannette, thank you so much. Really appreciate it.
Thank you.
We're going to have all your markets action ahead here on Yahoo Finance. Stay tuned. You're watching Morning Brief.
Now time for some of today's trending tickers. We are watching Gap, Ulta, and Dell. First up, Gap warning about the impact of tariffs, saying it will cost the company $250 million to $300 million without mitigation efforts, and up to $150 million with mitigation efforts. The company says it's already taking steps to diversify its supply chain and reduce its exposure to China. Despite the warning, the retailer's first quarter results did top expectations. However, investors sending them lower here, extended hours by about 16% here. Two things that jumped out to me from the call, at least. They talked about inventory, maintaining disciplined inventory management. They did have, and they ended the fiscal year with levels up 3.6% year over year. They said that the increase was primarily due to the timing of some of the in-transit inventory, of course, as they navigated some of the macroeconomic conditions. Also, on what they're saying on the consumer, they are saying that they've still been operating in this highly dynamic backdrop for the last several years and expecting the same for 2025. But they are seeing growth across different income cohorts in the fourth quarter, at least here. All income cohorts.
Absolutely. And that's really important given the Old Navy brand and the Gap brand as well. But given the fall off that we're seeing in the stock this morning, I just wanted to take a look at Gap year to date here. As you can see, well, that's going to need a couple of minutes because we are ahead of the market open here, but they are on track to erase the year-to-date gains that they have. So it looks like it's up 18% year-to-date, but that is set to erase. So just showing you the degree of today's drop. They also had a revenue fall for Banana Republic in the first fiscal quarter compared to a year prior, and they also had some pressure in Athleta as well, which initially we had been talking about as a competitor to Lululemon, and now we're seeing a little bit of a fall off there. It's interesting that the tariff hit that the company put forward is being perceived so negatively by the street. A Citi analyst this morning saying that it was surprising that the tariff burden was expressed to be so high, but Gap did say that they think they'd be able to handle about half of that $250 to $300 million tariff hit. So obviously it would be half that level in terms of the impact on operating income. But of course, it's just going to depend on what happens with the tariffs as well. And you can see, obviously, that putting the stock under pressure. We'll have a conversation with the CEO coming up here. But next up, let's talk about Ulta raising its full-year outlook after reporting better than expected first quarter results. The cosmetics retailer seeing strong demand as consumers continue to spend on beauty. Those shares up over 11%. Taking a look at some of the response that we're getting in from Wall Street here. Citi saying, given current momentum in the company, we continue to see upside. And this is the key here. A lot of the notes I'm getting in this morning saying they think the guidance that the company gave was actually conservative. They see bigger growth than the company signaled going forward here. Bloomberg Intelligence saying with their continued execution, they again see the outlook that was given as conservative.
Yeah, under promise, over deliver, even if the under promising still is very favorable. And one of the things that, of course, within this optimistic outlook that they were talking about, forecasting net sales between $11.5 billion and $11.7 billion. Company expecting comp sales growth as well within that to range from flat to 1.5%, potential decline second half of the year. But I mean, this squarely fits into that little luxury part of your portfolio or trading thesis. If you think that in times of a consumer at least weakening in the vibes, then they're going to lean into the little things that bring them happy. Your little cup of coffee there, whether that be from S-Bucks or whether that be from, Brooklyn Bagel down the street from me every morning, or whether that be into some of the makeup, the powders.
Little lipstick.
Ali Canal and I were talking about starting a men's powder business. It hasn't gone so well in the past, so maybe maybe we hold off for a little
I'll
bit.
Subscribe to that. I like it.
We're rounding up investors, so we'll
More to
report
come.
back. Yes. Finally, here, let's talk a little Dell. Dell lifting its full-year profit outlook, saying it is seeing, quote, unprecedented demand for AI-optimized servers. The company also expects profitability to improve in its computer and servers and storage businesses here. Shares of Dell right now, they are down, dude, by about 1.6%.
Yeah, interesting to look at some of the analyst commentary here. AI server demand and orders in fiscal first quarter as well were greater than typical deployment expectations. JP Morgan saying they're well positioned to lead the industry in relation to AI deployments and differentiated capabilities. They do talk about some softness in the macro potentially hurting the company, and that could be why we're seeing these shares moving to the downside just a bit this morning. You can scan the QR code on your screen to track the best and worst performing stocks with Yahoo Finance's trending tickers page.
Coming up, everyone, we've got all your markets action straight ahead. The opening bell on Wall Street and in Times Square. You're watching Morning Brief.
That is your opening bell on Wall Street. Taking a look at the NASDAQ and the NYSE, where we've got Darden ringing the opening bell, Brad.
Oh my God, just makes you want some salad and breadsticks, right?
Absolutely, absolutely. You can see there the New York Stock Exchange and the NASDAQ here for that opening bell here. But let's take a look at where the major averages are this morning. You can see stocks under just a bit of pressure off the back of a couple of things. The idea that the tariffs that maybe were going to be voided now potentially back in place. You've got your S&P 500 off just about 0.2%. I'm going to wait for the NASDAQ to adjust for me here. But let's actually take a look over the last month because it is the last trading day of the month. And you can see your S&P 500 up nearly 6%. If we are able to close there, that would be a record in terms of gains on the month. And if we zoom out a little bit more here, take a look at where we've been since those Liberation Day lows. This is around April 2nd, and then we had that huge drop off the back of those tariff announcements. Obviously, we are ahead of both of those, right? We're about 4% above where we were on April 2nd. So the stock market here potentially not showing us signs that investors are too concerned about these tariffs staying in place, given that investors have moved past it, instead focusing on the taco trade. Trump always chickens out when it comes to tariffs. That is the sort of sentiment taking hold on Wall Street here. Taking a look at your tech-heavy NASDAQ, it is taking on the majority of those losses here. It is down just about 0.4%, Brad.
It is time now for today's strategy session. U.S. stocks poised for their best May since 1990. But could the rally be running out of steam? June marks a historically muted month for stocks, and investors await a Fed decision and more trade volatility. Joining us now, we've got Callie Cox, Chief Market Strategist at Ritholtz Wealth Management, which oversees $5.6 billion in assets under management. Great to have you here with us, Callie. So just take us into the setup going into June and where there are pockets that investors should either be leaning into or leaning away from.
Well, hey, I can't say I'm any happier than what we've seen in May. You said it. We've seen the strongest May in 35 years. And, you know, if anybody was sitting there in mid-April, predicting this, I'd probably call them out on it. So what we're looking at, Brad, right now is, a strong market fueled by a sentiment rebound, fueled by a rebound in tech stocks and consumer stocks as tariff fears have abated a little bit. But as we've seen this morning with the Truth Social post that came out, tariffs aren't completely out of the headlines yet. I mean, yesterday was another good example of that as well. So I think heading into this summer, especially after such a strong bounce, it makes a lot of sense to be cautious.
But Callie, great to speak with you as always. I was just talking about how the stock market is up about 4% since April 2nd. Have investors moved past any tariff risks that could still be present in this market? And if so, how offsides might investors be caught if these tariffs do end up being stickier than they're currently pricing for?
I would say yes there. I think that markets have moved pretty far past the tariff fears, especially because we've gotten a lot of economic data showing that, number one, companies haven't passed these prices along. And number two, these tariffs have hit spending, but not as hard as some people feared, especially that I feared in the middle of April. I don't think we're out of the woods yet. And when I say, to be cautious heading into this next month, I think it's a good setup for long-term investors. I think many setups are good for long-term investors, but to expect markets to drift higher through this month full of news, I think is a little optimistic.
Yeah, and how much of that news do you think will actually place more of and continue to place more of the emphasis or more of the kind of mindset around what's taking place with the he loves us not of the tariff policy and negotiation front versus what the Fed is going to say during the month?
Well, I think the Fed is the bigger focus because I'm looking on a longer time frame, Brad, and you guys know me, I'm a big Fed nerd. We're going to get, I mean, based on the past, we're going to get a lot of he loves me not, the taco trade, the tofu trade. We're going to get a lot of that talk back and forth, but what investors really need to be focused on is economic data, especially the jobs week that's coming up next week, and what the Fed is doing in response to all of this data that we're getting, which honestly, the Fed isn't in a good place right now to do much. And I think markets haven't quite processed that, the fact that the Fed can't step in and help us if the economy does end up weakening.
So, Callie, given all of that, where do you see the leadership in the second half of this year? Obviously, this week we've seen a lot of growth in tech off the back of those NVIDIA earnings. Do you think big tech is going to be the cyclical leader in the second half? What are you foreseeing when it comes to sector performance?
Well, if you expect a slower economy over the next few months, then you'd probably guess that the leadership would lean defensive. The more utilities, real estate, consumer staples, or sorry, not real estate, but utilities and consumer staples definitely stick out in my mind here. It all depends on what we see from the economy. I think the economy has been surprisingly resilient. Tech makes me a little worried here. There are really high expectations on the back of tech. And like we saw with NVIDIA's earnings, I mean, some companies can blow past those expectations and, beat them more than anybody expected. But I think that those companies are few and far between. And look, when the economy is slowing, when investors are still a little nervous, it's best to search out those sectors that don't have high expectations, assuming that the market may have more trouble beating them.
Callie, I'm sorry, you have to tell me what the tofu trade is.
Well, I stole this from somebody on Twitter, and it's Trump. I forgot what the O means. I'm sorry, I'm totally failing here, but it's basically the opposite of the taco trade. It's Trump likes to mess around when markets get high, and he likes to test the waters with new tariff news.
Interesting.
Callie, thank you so much.
Always I'll come back to you with that.
To get your insights. Hey, we'll be DMing you on Twitter. We got time. All good. Thank you, Callie. Appreciate it so much. Always. Thank you. Let's get to the three market movers you need to watch for the trading day. Yahoo Finance's Jared Blickery has more.
Guess what? Stocks are surging in May, so I got the monthly roundup, I got the weekly roundup, and then we're going to dive into a little bit of crypto and commodities as well. We got digital and physical gold on deck. But first, let's review the month of May. The headlines are saying this is the best May since 1990 in the S&P 500. I went back and found that it was the second best May going all the way back to 1948. So this is something that's very unusual, especially for this time of year. I've done segments on go sell in May and go away. Well, that's not necessarily always the case, and this month kind of bears that out at least. And let's take a look at the performance for May behind me. S&P 500 up 5.7%, NASDAQ up a whopping 9.31%. That's a composite. And by the way, the NASDAQ having the best month May since 1997, so that is a significant inroad there. And let me just go over some of the winners and losers, and I'll start with the S&P 500. This is month to date, the top 10 and the bottom 10 in the S&P 500. So we got 20 total. NVIDIA and Tesla, those are big standouts. Those are the two big rectangles you see in NVIDIA. Both of those up about 25%. But healthcare was really taking it to the downside this month. We're seeing Eli Lilly down another 20%, United Health down 27%, Merck down 10%. But some of the winners here I've been tracking in these diverse industries, guess what? GE Vernova up 27% this month, and you can see up 43% the year to date. We have Carnival Cruise Lines, very unrelated industry, still underwater for the year, but up about 25% for the month, on par with Tesla and NVIDIA. Also, Seagate Technologies up 29%, Energy up 41%. And let me just go to the NASDAQ real quickly and just show you how that's shaking out. Pretty bullish picture here, and especially with respect to the mega caps, except for Apple. You're going to notice that's down about 6.4%, that big red rectangle right there. But for the most part, a lot more winners than losers. And let's now check out the weekly winners and losers in sector action. Thought this was interesting. Real estate is now topping. Tech was up there too, but it's slipping today. Looks like real estate 2.3%, and actually we got to convert this to a 4-day. There we go. 2.2%. Then we have consumer discretionary up 1.7%, then tech up 1.6%. All of those outperforming. So interesting mix at the top there. Energy taking it to the downside. And let me just move on to futures real quickly. Crude oil was catching my eye. And let me put this on an intraday basis. It is off about 85 basis points right now. This is a year-to-date chart. It just recently touched this morning a 3-week low and kind of bounced off of that. Weak crude oil is something that I've been tracking here as a barometer for global demand, so we want to keep an eye on that. I will close with crypto here because Bitcoin briefly dipped under 105,000, but it now popped back above. This is a year to date. Let me just dial this down to a 2-day so you can see the price action. Still looking very bullish, but I guess we're just searching for that next catalyst to catapult it to new highs beyond 110, 111,000. Back to you, Brett.
Jared, thanks so much. Setting the scene for today's trading session. Coming up, everyone, Gap looking to mitigate an expected $300 million hit from tariffs. The company's former CEO weighs in on the turnaround strategy plus the retail environment at large. Next on Morning Brief.
Gap plunging after warning of the impact of tariffs, saying it could cost the company $250 million to $300 million without mitigation efforts and up to $150 million with current mitigation efforts. Joining us now, we're thrilled to have Mickey Drexler, Alex Mills, CEO, and former Gap CEO as well. Great to have you, Mickey.
Nice to be here.
I want to get your reaction to these Gap results. The stock is on track to erase its year-to-date gains. What do you make of how the company's handling it?
Because the last time on Yahoo, you all asked me what I thought of Yay,
I know, but
Okay.
Mickey, come on.
But then they all got mad at me when I thought it was a mistake.
I know, but let's talk about Gap this morning. What is your thought on how they're handling these tariffs?
Honestly, I think I said this to you. I can't talk about it because I'm a difficult human being in the retail world. And I'm just going to be a little positive.
How do you think about how the retailers are handling tariffs in general right now, then?
We're all scared to hell.
Yeah.
We're all flying blind every day. It was 2 nights ago, I cheered because the courts, who knows what to do? And how do you take a business and not know what the cost of your goods are?
Right.
And everyone says raising prices, doing this. And Walmart got a lot of attention and anger from some parties, but just make a decision whether it's good or bad so we can live with it. We are flying blind. How do you plan the business? How do we have to put retail tickets on our goods now. And, and then we have to take them all off, change them, this, that, and the other thing. So that's how I feel. And I read about these tiny, China is America's factory headquarters. Think about it. All these little companies, you can't make stuff. And in apparel, there's really no industry, because the sewers, the this. We're a great country, but practically speaking, Apple, what are they going to do? What are people going to do? And then people are concerned because, what can you say?
How are you managing supply chain through an environment like this?
Well, no one has any experience. We're smallish. So, the $250 million, I'm sure that's not hard for all the big companies. So we're probably a % of that based on sales.
At Alex Mill.
Yeah. What we're doing, we're very late. And Alex Mill, when I left J. Crew, the tariffs of a few years back were a warning for all of us to move from China. Well, at Alex Mill, long story, we didn't. I'll take the blame, of course, but we didn't move. And so we're now moving as quickly as we can.
What percentage of that is specifically China-based for Alex Mill?
Can I whisper it or I have to say? It's too much. But, it's a good warning for us. And we're dealing with it, but not easily. They say prices. We're looking at prices surgically, style by style. When someone says they're raising prices, It's like saying all of America is snowing or this selectively, and where we have strong franchise businesses where we feel we can take a little extra. But the other thing, and stop me if I'm talking too much because I know the clock's ticking.
This is good context, though.
Okay. The world is discount. It's a discount world. I asked Brooke, I won't mention it, where she got that blazer. Beautiful. She said, my favorite store, you know where she got it, right?
Oh. What was it?
Okay, I'll tell you later.
Okay.
But she got it at a discount company.
Well, I have a feeling I know what it is
When
now. Yeah.
you walk into that business, you know the price is the real price. And, it's just, and that has nothing to do with tariffs. It has to do with up and down pricing. It used to be called that when I started my career at Bloomingdale's. It was high-low pricing.
Yeah.
But, the integrity of pricing today, I look at the ads when I watch CNN or MSNBC or Yahoo Live, 50% off. Everything's on sale.
Yeah.
Prevagen will make someone have a better memory, or the brain now, they change it. And people, I said to our team the other day, they said, this sweater, which is the best sweater, they had 6 perfect. I said, you lose all the trust. Say what doesn't work. Say the duck is not cooked enough or whatever. And I said, just get the real world. Because the credibility, to me, I don't trust so much today.
Right.
Anyway.
So it's such great context. What do retailers do then? And not necessarily what they should do, but what do you see them doing? Are they compromising on quality? Are they waiting out the next 4 years under this administration and just eat the tariffs for 4 years and then figure it out? What are they doing?
Well, every time I'm on something, I have a little group of 5. And they're all in different businesses. Most people don't know what to do.
Yeah.
Because they're not waiting it out. How could you wait it out? Where's it going? Where's the end game? I think they're all, when I call them, I called everyone tariffs. Who knows? And everyone was happy the day before because the court said no. Right. And then yesterday morning or whatever, then they overturned that.
Doesn't that show, though, that maybe you shouldn't spend a ton of money moving out of China because you could spend all that money and then the tariffs could go away?
That's a very smart question because Chinese, they make the most, they're very high quality makers. Some of them, not always. The quality has come out over the last few years, from my opinion. For me, it's always quality, style, value, fair pricing. And we're very fairly priced.
Yeah.
And I'm not one of those big markup, put it on sale. We have a little tiny stuff on sale today. You have to get rid of the goods. But I think people are at a loss. We're trying to, we hired someone new from my old company. She's been with me 28 years. She's the new head of production for the last 2 or 3 months. That job is one of the most important jobs in any industry. How do you make the goods? Where do you make it? Right. She has a lot of networks. We're moving goods out, and a lot of vendors who we know, we're not big customers, are mitigating the issue. They'll split it, they'll do this. And in America, we looked at some people, there's not a lot of choice because it's not just pricing. It's about the skilled workers.
The craftsmanship, the quality that goes into it.
100%. It's nothing against America, but they're brilliant at we are, a lot of other things.
Sure.
But apparel sewing is not.
I want to ask you something else here, especially knowing about your time at Bloomingdale's, knowing where that sits within Macy's as well, who we just got earnings from recently. You at Alex Mill, you sell into Bloomingdale's. You have a good partnership there as well as with some other retail partners. That's a very high-income consumer that we're talking about, though.
Okay.
What are you seeing among the high-income consumer who's been told that you're the ones upholding the broader economy and the spending right now? And if you collapse or if you pull back, then the rest of it might start to trend lower.
I always ask, who are the authorities that say that? Brooke was a perfect example. She looks like The blazer's beautiful. I felt it.
You just tell Brooke to come in the studio here.
Yeah, Brooke, you want to show the blazer? And I think the lower income for sure are going to get hurt. Here's Brooke. I'm not going to tell my friend, she doesn't like me. But I said, look at the blazer.
Here she is, you guys.
I mean, I'll admit this blazer is actually from TJ Maxx.
It's beautiful.
Okay.
And yeah.
And it
Well,
looks amazing.
my friend Carol there told me never to mention her name. But you know the difference there in their business? You go in there and the prices are the prices.
Yeah.
Right? You didn't have to see on sale 40%.
Thank
All
you,
right,
Thanks.
Brooke. Always. Now they're going to think she's a twin of yours. Anyway, so it's just very difficult to.
Yeah.
And there's a whole other program on doing business today
Yeah.
at retail with wholesale. We do sell shops mostly because we sell good shops who show our goods, and we also sell them because we have minimum quantities from factories.
Right.
And so you have to buy 100 of a color, which is actually a lot for us. And my old jobs,
That is, yeah.
My old jobs didn't mean anything.
Mickey, we could talk all day here. We appreciate you joining us here this morning.
Okay.
Thanks so
Pleasure.
much.
Thank you.
Mickey.
Mickey Drexler.
Thank you.
And you can stay tuned. Tune in at 10 a.m. Eastern for an interview with the Gap CEO, Richard Dixon, following the company's first quarter results. Stay tuned for that. We've got all your markets action straight ahead. You're watching Morning Brief. Costco topping third quarter earnings estimates, but falling slightly short on revenue. Still, sales increased 8% from a year earlier as consumers flocked to value options. Yahoo Finance's Brooke DePalma is here now with the biggest takeaways from the results from Costco here. Brooke, what do we know?
Costco has remained competitive in this environment, and that's the reason that CEO said that they did well this quarter with that competitive price position. If you take a closer look at what analysts have said on the street, is that Costco tends to execute well in this uncertain operating environment, and that's what we saw play out this quarter. They outperformed Walmart, they outperformed Target, not only in terms of same-store sales growth, but also in terms of traffic. And what they were able to do this past quarter is offer what customers want: sharp prices and value for their money. They said that they were able to lower costs of eggs, butter, and olive oil. We also saw certain items that consumers have been pulling back from, like gold and jewelry, toys, health and beauty, be the ones that customers gravitate towards this past quarter. And lastly, they were able to manage tariffs well. Wall Street certainly pleased with that. 1/3 of its sales in the U.S. are imported, 2/3 of those are non-foods, and they import just 8% of U.S. sales from China. Also, inventory expected to do well, expected to be in full stock this summer. They said they were able to pull ahead patio furniture and sporting goods. So, hey, good news there.
Summer goods. Brooke, thank you so much, and thanks for modeling with us earlier.
Anytime.
Really appreciate you as always. That's going to do it for the Morning Brief. Join me in the next hour for more analysis on Catalyst Ground.